My name is Jamil. I'm here to talk about asset tokenization strategies. Typically, this lecture is something that I give in New York. Usually takes about 2 or 3 hours. I was asked to bring it down to 10 minutes, so I'm going to try my best, see what we could do. So the company that I'm involved with is called Chainhouse. We're based in New York City. We focus on 3 or 4 really important things. One is that we do advisory in blockchain, AI, and data science. We also help raise capital. In the U.S. right now, the term ICO is kind of defunct. The term that's used right now is STO, is a security token offering. And if you are looking to raise capital in the U.S., you need to register with the SEC. So we are involved with that via our broker-dealer arm. And we also do a bunch of events and marketing. And that's all I'm going to talk about in terms of what we do. I'm going to make sure that this presentation is educational as much as possible. So what I first want to talk about is asset. We all have different definitions of what assets is, but in general, these are the main characteristics that we look for when we define an asset. One is that an asset is a thing, whether it's tangible or intangible. It also has a value, and really it's a set of rights, right? So when we acquire an asset, it's a set of rights that we're acquiring. And a token is an arbitrary unit that is exchangeable. And so if we are talking about cryptocurrencies are tokens, but the tokens can also represent something else. So they're a unit of representation that is stored, or transfer of that is stored on the blockchain. And this is really important to understand this new wave called asset-backed tokenizations, or asset-backed tokens, which is going to usher in a kind of the next stage of investments in the blockchain space. Now, what's the difference between cryptocurrencies and tokens? In general, there's a bit of blur between the two. The way that we differentiate it is cryptocurrencies typically have purchasing power, whereas tokens don't typically have purchasing power. So a cryptocurrency can be a token. So a token is kind of a subset, but a token doesn't necessarily have to have purchasing power. A cryptocurrency does. So Bitcoin has purchasing power, Ether has purchasing power, but certain tokens that might represent assets do not have purchasing power, even though they have value. So we see if you are looking to purchase, let's say, a property, you put up some money and you pick up this property, and that is a acquisition that you make. However, in reality, what you actually are buying is something like this, which is called a bundle of sticks. And if you study real estate law, especially in the US, there's a notion called bundle of sticks. Actually, each one of these sticks is a right. So actually, you are not buying the property. What you are actually buying is a set of rights. And these rights include things like possession, disposition, control, meaning things that you can own the property, you can destroy the property if you like, and these are the rights that you acquire. So when you actually are purchasing property, you are actually purchasing and transferring these rights to you, right? One or more of these rights. Right, so one of the issues that we have with cryptos, and we see that in the past couple of weeks as the crypto market is fairly volatile, is that there is no valuation mechanism for a Bitcoin or Ether. How do you value Bitcoin and Ether, right? You can't use DCF, you can't use price to equity ratio, you can't use any of these techniques that are typically taught in business school, and that leads to high volatility. And so what we see happening in the U.S. and we see it happening in other parts of the world is there's a movement from cryptocurrencies that have no tether, they're not tethered to anything, to starting to take some of these cryptos and start to tie them down to assets. And the way it looks like is that you take a token and you associate that token to some type of assets. And there's different models and different approaches in doing this. And I'm going to go over 3 or 4 different models about how we can do this. The benefit is, one, by default, you have fractional ownership, right? You create fractional ownership around an asset. 2, you create liquidity for that asset where that asset may or may not have liquidity previously. And 3, it allows for valuation, meaning that because it's tied to an asset, you can now perform some type of valuation and figure out if that token is worth that price or not. So an example is I can issue 100 tokens, and I can then associate these tokens to a particular house. How I do the association is a little bit more involved. And then if I were to sell those 100 tokens, I am actually selling the house, right? So I'm able to sell 50 of those tokens. I've then sold half of that house to a different owner. And I've kind of created this fractional ownership around this property. So this is what it looks like in a conceptual manner. So there's different ways to go about this. One of the ways is called a pooled net asset value. NAV is a mutual fund, hedge fund terminology. So what I can do is take a whole bunch of assets that are homogeneous, meaning they're identical, pool them together, and then issue tokens for that pool. And the use cases for this can include, let's say, oil reserves and gas reserves. So let's say I have a billion barrels of oil. I issue 100 million tokens. Whoever owns those tokens owns that oil reserve, right? And we see there are companies out there that are starting to do this. There's a company called oilcoin.io that we do some work with, and some other companies that are doing this type of thing. It's also applicable to equities because effectively equities is fractional ownership of an entity. The entity can be put into a pool, and you can issue an asset-backed token against the balance sheet of that company. The other approach that's emerging, some of you may be familiar with this, is what's called non-fungible. In the previous example, we had a fungible token. The fungible token is if I have a token and you have a token and we exchange it, there's no net gain or loss in that exchange of that token. But with fungible, a specific token is tied and associated to a specific asset. If I have a token A and you have token B and we exchange those two tokens, they don't necessarily are equal in terms of value. I might be giving you some profit or loss or vice versa. And examples of this we see is, if you've heard of CryptoKitties, they use non-fungible tokens. But we also see in the US, there was a real estate deal just done in Vermont using a non-fungible token. Somebody bought a token that represents a specific piece of property. And the minute they bought that token, they own that house. The other emerging standard is divisible and non-fungible. I can take a pool of tokens associated with a specific asset and a number of assets. So let's say I have a house, I issue 100 tokens, right? Or I issue one token, and then that token is then divisible. I can divide that token out, right? And this is an emerging standard. I'll show you some of the Ethereum ERCs that are coming out that are dealing with this. Finally, there's second to last is if I have a pool of assets that are not homogeneous, all right? Let's say, for example, I can take a storage shed that I'm auctioning off. It has a ton of different things. I might not even know what it is, right? Mutual funds, which may include a bunch of different types of assets, right? Or index fund. This is another strategy that's used, and we see this kind of emerging. We'll see more of this in 2019, 2020. And finally, the last strategy that we see that coming out is the taking out of a specific right. For example, in New York City, air rights are a precious commodity. If I want to sell my air rights, the air right is basically the space above a property. I can sell that separately from the property, and we'll see that asset rights are stripped out and taken out almost into tranches and traded separately. So an example of these use cases is, let's say, the right to read an academic paper might be purchased by a token, right? Or a lease or IP. So. Now, there's some Ethereum standards that are out there for this. One's ERC20. Everybody's familiar with fungible ERC20. ERC721 is non-fungible, and there are some new standards like ERC888 that are kind of emerging. There are some challenges in this space. One is called arbitrage. I can take a token, its value may go up and down in relationship to the underlying asset, and that might change. The second is governance. How do I guarantee a specific token is associated with a specific asset? What if the asset has a serial number and I can modify the serial number? How do I manage that? Finally is custody. How do I handle custody? Who is going to hold the asset? Does the issuer of the token hold the asset? And there may be a conflict of interest there. So these are some of the strategies that we use. If you're looking to get some reading material, I recommend these resources. A quick thing about me, I run Chain House. I have 15 years of technology experience. I run one of the largest blockchain meetups in New York City. I'm a graduate level professor in blockchain, AI, and data science at NYU and at CUNY. And that's us. Thank you, guys. That's the link for the slide deck. Thank you.